Most people in the world, when they want to be a business owner, they'll start a company from scratch. And it's actually the most craziest suicidal thing you can ever do. I'm the worst manager in the world. If I was the general manager of a business, it would die within 24 hours. So I own 17 companies today. I don't work in any of them. 0. 1 in 10 businesses ever get to 7 figures. But you could double that business in an afternoon by acquiring another business. If you want more assets, you can buy them. You want more customers, you can buy them. You want more employees in your business, you can buy them. If you own a business, how you can buy everything you want and use other people's money to do it. I'm going to show you how you can wholesale business deals and make millions. But a lot of the times, if you're doing a seller financing deal, the seller doesn't care about your credit. He just wants to sell the business, and he wants to know that you're the right person to take that business forward to the next level. And there are 3 major skills that you need to master to crush this as a deal maker. Section 1, we're going to talk about, why should you buy an existing business versus starting a business. Most people in the world, when they want to be a business owner, they'll start a company from scratch. And it's actually the most craziest suicidal thing you can ever do. What you're going to learn over the next 3 days is not only why buying a business is the smart way to be a business owner, to generate cash flow, wealth, all those amazing things, but we're going to teach you how to do it, right? So it's going to be like drinking from a fire hose. We've got a lot to pack in. But I've been doing this for over 30 years. I've done over 400 deals, tens and tens of billions of dollars, Wall Street, Main Street, private equity, family office, you name it. So my goal, together with Chris and Abraham and Pace, is to try and get all of the IP in my brain into your brains over the next 3 days. So let's talk about why you should buy a business, and then I'll walk you through all the different types of acquisitions and deal maker moves that you can make, which we're going to go through, and we're going to teach you all of them this weekend. So I look at business ownership like owning a car. Hands up if you own a car. Okay, everybody owns a car, right? Now, there's 2 ways that you can own a car. You can go on eBay, and you can buy the engine, the glass, the chassis, the exhaust, the wheels, and then you can go on YouTube and figure out, how the heck do I plug all this stuff together and make it work? Or do you go to a dealership and you buy a car that someone's already built, right? And then what's great about owning a car is you can buy a car without having any money. You can lease a car or finance a car. You can buy it for no money down. So that's an analogy that's going to run through this whole weekend. We're going to teach you how to buy businesses without having any personal capital, how to get capital into deals that's not necessarily your money. So there are a lot of reasons to buy an existing business. You've got cash flow, it's faster than starting from scratch. When you buy an existing business, you're walking into cash flow on that very first day. And a lot of people that are stuck in W-2s, they're working for other people, they can't go on vacation when they want. Being your own boss, having your own business has a lot of benefits. Has a lot of benefits for freedom and time and all those different things. And when you buy a company that's been around for a long time, you can learn a lot of the different things from that business owner. And what's interesting is if you were to go and start a business, it's almost impossible to raise capital. You've got to go to VCs, they'll take the majority of the ownership. When you buy a business is a separate legal identity to you, and it has a credit. So you'll all have FICO scores if you're in the US. A business has its own version of a FICO score. And if a business has got good credit, you can borrow money from a bank to finance your acquisition of that business. Existing businesses as well have reputation, they have credibility. So one of the hardest things when you start a brand new company is no one's heard of you. You've no track record. You're buying a track record when you buy an existing business. I'll show you some stats in a minute, but virtually every small business that tries to start fails. 96% of small businesses fail. Only 1 in 25 businesses survive, 4%. So if you buy one of those 4% businesses, it's like running a marathon, but starting with 200 yards to the finishing line. And all the things that you don't have when you start a company, you don't have any employees, any credit, any premises, any cash flow, any customers, you don't have any of that. When you buy an existing business, you have all of those things and more. Okay, so if you own an existing business, let's say you had a business and you started it 5 years ago and you've just got to $1 million in revenue. Only 1 in 5 or to 1 in 10 businesses ever get to 7 figures. But you could double that business in an afternoon by acquiring another business. If you want more assets, you can buy them. You want more customers, you can buy them. You want more employees in your business, you can buy them. You want more profits, you can buy them. We're going to show you this weekend, if you own a business, how you can buy everything you want and use other people's money to do it. So I don't want everyone in here to think, well, I can go and do one deal and then I've made it. Once you've done it once, you can rinse and repeat and buy as many businesses as you want. But what's really interesting is all the big companies in the world. So look at Amazon. It's a $2 trillion company today in terms of its valuation. And they've acquired over 100 businesses in the last 15 years. So you think when somebody ran into Bezos' office one day and said, hey, Jeff, you know what? There's this new technology that's just come out. It's called Audible. They're eating our lunch in the marketplace. Like, what are we going to do? Do you think Bezos got his R&D team together and said, guys, you know, we got to figure out the tech stack on this. We've got to figure out a distribution model. We've got to figure out how we differentiate. No, he just went and bought the company. When he realized a few years ago that retail distribution of food was going to be the next big thing that's going to move online, do you think he figured out, how do I build a supermarket, build a supply chain, get suppliers? No, he went and bought Whole Foods. So if you want to grow an existing business, you can grow it by acquisition. We touched on the data before. What's crazy, I can't understand this. It blows my mind. Every year in the United States, there are 6.6 million entrepreneurs will start a brand new business, according to the SBA. Half of them will fail in 1 year. 80% of them will fail after the 5th year. And then by year 10 years in, so if you started a business today in 2033, only 4% of the companies will have actually survived. It's absolutely crazy. So why would you start a business? Why not go out and buy a business that's 10 years old and you're eliminating all of that risk, all of that pain, all of that brain damage that you're going to get by starting a company? But what's even more staggering is today there are over 2 million small businesses, sub $10 million in revenues for sale right now. So we're going to do a lot of training over the next few days about where to find these deals and how you talk to sellers and build rapport and negotiate win-win deal structures so you can buy that business with zero money out of pocket. And the US is the largest market in the world for doing these deals. It's really tough to do deals in places like China and India, which have more population. But the United States, if you take the USA, UK, Canada, Australia, which are the 4 key markets where a lot of our students and protege members are doing deals, the United States really is the country with the most opportunity. But what's crazy about all these businesses that go to market is only about 1 in 11 of them actually sell, okay? And there are a lot of reasons for that. One of the reasons is a lot of people actually don't know how to buy a business, right? They think, if I've got to buy a business that's $1 million, I've got to rock up with $1 million check to buy it. You don't, and you're going to learn this weekend how to actually do that. And what's really interesting is a lot of people don't realize that you can buy a business and be an owner rather than a general manager. People think, well, why do I want a business? I don't want another job. I might as well stay where I am. So I own 17 companies today. I don't work in any of them. 0. The businesses would fail if I worked in them. I'm not an operator. I'm a visionary. So you can be an owner-investor, not an owner-manager, and have people run the businesses for you. We're going to teach you about that as part of this weekend. There's a lot of pain in the market as well around business brokers. Abraham and I are going to give you a session on how to work with business brokers. Business brokers are like Zillow. They're like the MLS. You can go to Biz Buy Sell and all these different places and see hundreds of thousands of businesses for sale. But broker deals are not the way to be super successful as deal makers. We can look at broker deals. Some of them are okay. But off-market deal flow is really the way to do this. So we're going to teach you a lot of that stuff over this weekend. And this statistic is actually getting worse. So we're in an unprecedented marketplace right now for buyers. This is the biggest buy-side opportunity I have ever seen in my 31 years of doing deals. We have 10,000 baby boomers every day that are retiring in the United States. 10,000. It's crazy. And most of them have no exit strategy, because if you go back 20 years ago, most family-owned businesses, they just hand the business down to a son or a daughter or another family member. But now children, they want to be Instagram influencers, they want to be YouTubers, or they might want to go and work on Wall Street or go to business school and do all those crazy things. They don't want to take over dad's engineering company in Boise, Idaho. They don't want to do that, right? So you've got these business owners now thinking, well, how do I sell my business? I don't know how to do it. I've got no idea how to sell a business. 95% of all the business owners you're ever going to talk to as a deal maker, once you walk away from this weekend, have never been through the process before. So you're going to be 1,000 times smarter than they are because you've been sat inside of this room. And one of the biggest things in small business ownership that blows my mind, so according to the Exit Planning Institute, the average amount of retirement savings that a business owner has in a 401k, a Roth, an IRA, whatever, is only $202,000. If you're 60 and you want to live for another 20, 25 years, you can't live off $202,000. Their business is their retirement pot. And we're going to show you tomorrow in a deal structure called Annuity deals how you can actually position a 100% seller financing deal over an extremely long period of time to help a business owner retire comfortably. So the art of deal making is simple. It's understanding what the seller really wants, what their issues are, and building a deal around that. And what will blow your mind this weekend is a lot of the time, it's not about the size of the closing payment. So the sorts of deals that we're looking at really are in that kind of $1 to $5 million sweet spot, okay? So the problem with going under $1 million or even $500,000 in some industries is you're really buying a job. And there's probably not enough cash flow coming through the business for you to make money and for a general manager to go in and run that business for you. So you're really buying a job. It's got no middle management layer. The owner will own all the processes in their head. They'll control all the customer relationships. You don't want that. Once you get above $500,000 or $1 million, there's middle management, there's SOPs, there's KPIs. You can work on that business, not in that business. And the reason why we stick to 10 million, you can do deals north of 10. I've done them. Deal makers in the room have done them. But really, when you go above 10 mil, a lot of those businesses are easy to sell. Because if you're a $25 million business and you want to grow by acquisition, are you going to buy 25 $1 million deals, or are you going to buy a $1, $25, or $10 million deal? It takes the same amount of time to do a $10 million deal than does a $1 million deal. So there's a job for somebody to buy up all these smaller businesses, combine them, and then you can sell them further up the food chain later. And there are lots of reasons why business owners sell. They want to retire, they're done, they're bored, they're frustrated, they might be going through a divorce, they might have major family issues, they might want to relocate, and they can't take the business with them. They're just not having fun anymore. A lot of the business owners that you talk to, and we're going to teach you all about seller psychology and how to really understand what's going on with that business owner, what you'll realize is a lot of these issues create urgency. And the more urgency from a seller in closing a deal, the more creative that you can be, providing that you're building the rapport and you're building the relationship. Sometimes you'll find a deal and there might be multiple shareholders. And it's happened to me, it's probably happened to a lot of people that are in business. Sometimes things don't work out, you fall out. You have a difference in opinion about how to take the business forward. And that can be an amazing way to get into a deal. Business owners just get bored from time to time and they see other opportunities. You know, Chris and I have been talking about this really cool idea that we're going to have going forward about trading your business. You know, like when you own a car and you're tired of the car and you think, you know what, I'd like to get the new model or I'd like to move to a different brand. You can take your car to a dealership, they give you a trade-in value, and then you can buy a new car. We're going to be doing that with business deals for all of these business owners that can't sell their businesses and want to go on to do something different. A lot of business owners they've been in for a while and they've made their money and they're not the $202,000 average retirement saver. They've got tons and tons of money and they just get bored. You can get super, super creative with doing those types of deals. Sometimes businesses are not profitable. You'll learn this weekend why you should stay away from unprofitable businesses unless it's a quick bolt-on to an existing business that you've already got. And a lot of business owners, they get to a point where they just want to cash out. They want to monetize what they've built over time and go on to those different things. And what's really interesting about business is if you own a business and you can't sell it, often it can cost you money to actually close it down because you've got payables, you might have taxes, you might have bank loans and liens and all these different things. So often we can use that to negotiate the price and terms that we want to do. And what's crazy is 64% of all the businesses that change ownership in the United States every year are business owners unable to sell, so they just literally close the doors and turn off the lights. So when we show you this weekend how to find those deals and how to build rapport and how to negotiate terms, you're actually doing them a favor. You're saving them from not only losing money, because it will cost them money to close the business down, but secondly, it's their pride and their ego. They want to go into the country club or the golf club and say to their buddies, hey, you know what? I just sold my business. They don't need to tell them like what the price was or what the terms were, but it's an ego play. You're going to learn this weekend how ego is one of the key values that we tap into when we're talking to these guys. And I did a survey about this several years ago. I polled over 2,000 business owners and said, hey, why did you sell your business? What was the driver for you to make that decision? And what blew my mind is only 20% of it was financially related. 80% of it were for non-financial reasons. They wanted to sell and leave a legacy. Their children wouldn't take the business on. They wanted freedom from the business. They wanted their employees to be taken care of by the new owner. So when you're meeting sellers and you're having these conversations, they're like, wow, it's like my knight in shining armor has come in. He's a safe, trusted pair of hands that can take the business to the next level. And just think about this for 1 second. Imagine you've got two businesses, but they're absolutely identical. They do the same product or service. They're in the same town. They've got the same employees, same customers, and the same financial profile. You're going to learn all about financial stuff this weekend as well. So they've got revenues, profits, assets. Everything's identical. The only thing that's different in that business is the owner. But more importantly, the owner's seller psychology. So take the business owner on the left, entrepreneur in his 30s, happy, having a lot of fun. Now, every business is for sale. It's just a question of how much, right? If you had $3 trillion today, you can go and buy Amazon. Every business is for sale. It's a question of price and terms. So the guy on the left, he's probably going to think, well, I love this business. I'm having a lot of fun. I've got no seller distress, which is a key term you're going to learn this weekend. I'll sell, but I want a 5 times multiple of profit. Most businesses are worth a multiple of their profitability. It's called EBITDA. We're going to teach you how to do that this weekend. He might want a 5x multiple, and then he might want 80% of that total cash at closing. So let's say he's doing $1 million in cash flow, $5 million purchase price. He wants $4 million at the closing table. Now, the good news is there's a deal structure to allow you to do that. It's called the SBA 7(a) loan. You're going to learn about that tomorrow. And those deals are great. I've done loads of those deals. People in the room have done loads of those deals. But really, we want the deals. We want the guy on the right. So it's the same business, remember. He's doing $1 million in cash flow, but he wants to retire. He's not having a lot of fun, doesn't know how to sell. He's distressed, he's burnt out, could be sick, could be even dying in some cases. He's going to sell for a 2 to 3 times multiple, and he's going to let you pay for that business over a long period of time. So he might take 80% or even 100% of that purchase price over a 5, 10, even 20-year period. My business partner, Chris, and I, we just negotiated a seller financing on a marketing agency, 21-year seller financing deal, 0 money down, because he was the guy on the right, distressed, burnt out, frustrated, doesn't want to do this anymore. You're going to learn how to do all this weekend, by the way. So one of the key things that you must start off with when you're buying businesses is determining what is your buy box. So your buy box is really, really important. Imagine it for a second. There's 2 million businesses in the United States. right? And there's only a couple of 100,000 people that really know how to do this. So you've got all this opportunity. It's like, I walked past FAO Schwartz in New York yesterday, and I see all the little kids running in and going crazy, thinking, whoa, look at all this stuff. It's like that, unless you're going into the toy shop knowing exactly what's in your buy box. So we're going to help you understand this weekend, what should your buy box look like? And your buy box should always have three things. Now, my buy box is going to be very, very different to Mark's buy box. It's going to be very, very different to Nathan's buy box. It's going to be very, very different to Michael Herbert's buy box. But your buy box always has to have three things. Number one, you've got to stay in your lane. You've got to buy a business that you know something about, you're passionate about. You can add a lot of value to that business post-closing as an owner-investor. And if you find a deal and you can't do that, just go and partner with somebody that can add that sector expertise into your mix. Really, really important. You're going to learn about that all this weekend. And again, sticking in this $500,000 to $10 million or $1 to $5 million revenue range. And the other thing that you've got to realize as well, and I touched on it before, is you don't have to work in the business that you buy. So some of you guys will think, well, you know what? I want to be an owner-manager. I want to buy a business. I want to go in, and I want to operate it day to day. There's nothing wrong with that. There's absolutely nothing wrong with that. I don't do that because I can't be in 17 different places at once, and I certainly couldn't be here this weekend coaching you guys. But if you want to be an owner-investor, you can buy multiple businesses and then partner with people that will run those businesses for you. So the sector requirements are really important. The second thing that's got to be in your buy box is ideally look for what I call a distressed seller of a good business, not the other way around. There's lots of good sellers of distressed businesses. A distressed business is a business that's not generating cash flow. You want to typically stay away from those. A distressed seller is somebody that owns a cash flowing business, but for all the reasons we talked about, needs to get out. They want to retire. They want to go and do something else. So the motivation to exit, which is the industry term for when you come out of a deal, the motivation to exit is really, really high. The higher that is mapped to the strength of the relationship you build, not only it could be cheaper to buy the business, but you can be a lot more creative in terms of the deal structure that you put around. And then the third thing that you need to have is some financial DNA. If the business has got assets, great, but really all it needs is cash flow. If the business has got cash flow, you can finance that acquisition with no money out of pocket. Absolutely critical. So we've just been through all this. So it's all about your niche, it's about your experience, it's about your passion, and it's about your ability to add some kind of value to that business once you've bought it. Because buying businesses is really easy. It's really, really easy. Once you bought a business, though, it's like, well, what do you do with it? You'll find out this weekend that you make most of your money on a deal when you exit. You buy a business, you scale it up, and you sell. That's when you make the bulk of the money. So buy businesses that you care about, and you can help move the needle. Motivated sellers are really, really strong, and it's got to have some financial DNA. It's got to have things like cash flow. That is king. The business doesn't cash flow. Number one, you're not going to make any money out of it, and number two, it's going to be really tough to get financing to buy it. Although if the business isn't cash flowing, it's typically worth $1 anyway. So there are a lot of common myths about buying businesses. People think you need to have tons and tons of money in your own personal bank account. You don't. You know, I never, ever, ever put my own money into deals. I'm doing $1 billion roll-up right now in the e-commerce space. Some of you in the room are investors in that deal with me. I've put zero money into that deal. Zero. I'm using other people's money to do it. A lot of people think that if a business is for sale, it must be a terrible business. You know, what are they not telling me? It's not. We talked about baby boomers. They've all got great businesses. When you get their tax returns, if it's cash flowing, you know it's a good business. We talked before about having management skills. People think, well, I've never run a business before. I don't know how to manage people. I'm the worst manager in the world. If I was the general manager of a business, it would die within 24 hours. I'm a leader, I'm a visionary. You can partner with people that can run those businesses for you and do that day-to-day work. A lot of people think that you've got to know everything about the business. You don't. You've just got to have a smart, capable team and middle management layer in that deal that can do all of those different things. Do you think Jeff Bezos knows how to do R&D? No, he doesn't. He's a leader. He's got people inside of the business that can do all that for him. People think that you've got to buy 100% of a business. You don't have to. You can buy 1% of a business. Ideally, you want to have a majority share, which would be 75%. A lot of people think, you know what, I want this deal, but I need some better people. I can't afford top-level employees. You can. You're buying the business for none of your own personal money. You have equity in your business that you can offer to people to bring them in. Every time I do a deal, I give my general manager equity in that business. Then they're my partner. So they're going to burst through brick walls for me. They're like, I turn them into a Marine. They're going to kill themselves to make that business successful because they're now my partner. They don't want to let me down. You're changing the psychology and the mindset of the people that you're partnering with. A lot of people think you can only buy businesses that are listed online. That's the biggest myth of them all. We're going to show you, and Abraham's going to do the majority of that coaching, is how to find off-market deal flow, how to use LinkedIn, how to write letters directly to sellers, how to build relationship networks. I recently joined the Sub-2 program. I couldn't even spell Sub-2 in real estate. Real estate's not my thing. I just bought 2 houses in Orlando. I didn't go to Zillow. I was part of a community. I put my buy box in that community. I got 63 deals within 25 hours. And I bought 2 of those deals with virtually no money out of pocket. So building networks, getting into rooms like this, meeting your fellow deal makers, that's where you're going to get deal flow. And a lot of people think you need to have great credit to buy a business. If you're doing an SBA 7A loan, you do. We'll talk about that tomorrow. But a lot of the times, if you're doing a seller financing deal, the seller doesn't care about your credit. He just wants to sell the business, and he wants to know that you're the right person to take that business forward to the next level. And there are 3 major skills that you need to master to crush this as a deal maker. The first one is your mindset, and Abraham's going to cover that next. Really, really important. He's going to teach you how to think differently. He's one of my most successful students and business partners. I'm partnered with him now on some stuff. He's got the most unshakable mindset you're going to see in this room, and he's going to teach you how to do that. The second thing that you need to do is you need to get into the habit of building relationships. This is a relationship business. This isn't Wall Street, where I grew up, and I was there yesterday reminiscing. When you're doing billion-dollar deals on Wall Street, which I've done in the past, it's all about financial engineering. You're buying a $2 million engineering company in Punxsutawney, Pennsylvania. It's about relationships. It's about rapport, and we're going to teach you how to do that this weekend. And then the third thing is about being intentional. It's about being routined. It's about continually doing the things you need to do to be successful. It's like going to the gym. If you want to build muscle, you want to go to the gym. As long as you go there 3 or 4 times a week and you do the reps and the sets and then you eat properly and drink plenty of water, it's biologically impossible for you not to build muscle. Deal making's the same. If you're going out there, you're originating deals, which we're going to teach you. You meet sellers. We're going to teach you how to do that. And then you make offers on those deals. We're going to teach you how to do that this weekend. If you're consistently doing that week in, week out, you biologically can't fail to buy a business, right? This applies to everything in life. Execution trumps knowledge every single time. So you've got to do the work. Really, really important. Let's quickly look at the 7 deal types. And then we're going to cover all these this weekend with deeper training. So your first deal, which is an LBO, you can do something called an SBA deal, which we'll talk about. We can do annuity deals, which is long-term seller financing deals, no external capital required at all. You can do things called bolt-ons or tuck-ins or roll-up deals. We're going to go through all those. You can merge businesses together. So if Ali owned a business and Mark owned a business and they're in complementary sectors, they could combine their businesses together and generate lots of synergies. We'll teach you how to do that. You can do consulting for equity deals. So you might think, well, you know what, I don't want to own a business, but I'm happy to be a partner in a business, add my strategic value, and take it forward, and maybe I'll do 10 of those and have a portfolio. My business partner, Chris Moore, he's going to teach you how to do that. He's the best in the world at consulting for equity deals. And then, hands up if you're in Sub-2, you're a real estate. Okay, so what's really interesting in the real estate world is there's this term called wholesaling, which I got to tell you, a year ago, I didn't even know what that meant. I wasn't a real estate guy. So wholesaling is where somebody goes and finds a deal, puts it on a contract, and then sells it to you and gets a fee, probably $5,000, $10,000, $20,000. I'm going to show you how you can wholesale business deals and make millions, make a percentage of the cash flow for 5, 10, 15, 20 years. We're going to go through that tomorrow. So an LBO, what a leveraged buyout stands for, it's a Wall Street term. That's where I've come from. A leveraged buyout is simply buying a business using other people's money. And leverage typically is associated with debt. So you're borrowing money that the business's cash flow over time is going to repay. And a great example of this, and any soccer fans in the house? I'm a huge soccer fan. So, not many. I'm in the wrong room, aren't I? So soccer, so Manchester United, probably one of the biggest clubs in the world, big club in the UK. They were bought by the Glazer family, who own the Tampa Bay Buccaneers. They bought that business for $1.4 billion in 2005, put none of their own money in. They'd been in my program. They'd figured out how to do it. They bought that business. They still owe about $500 million of debt, but they're about to sell it for $7.2 billion or $6.7 billion when they repay that debt. So they're going to make a $6.7 billion profit from that deal without putting in any of their own money. And one of the things that investors talk about a lot is return on investment. Well, if you're not putting any money into a deal and then you're profiting from that, your ROI is infinity. If you divide your profit divided by what you've invested, if what you've invested is zero, any number divided by zero is actually infinity. So there's a lot of benefits to leverage buyouts. We're going to cover all of these this weekend and show you how to do it. But the basic structure of an LBO is the total value of the deal has 3 components. Number 1, you'll inherit the existing liabilities. Number 2, in some cases, but not all, there might be a closing payment. So you're borrowing money from assets or investors to put money down at close. And then some of the deal is going to be seller financing and or something called an earn-out, which is a bonus payment, which we'll teach you how to do as well. And then, I touched on this before, there's 3 ways to make money when you're doing a deal. The first time is you can, but not always, take some cash off the closing table. So if you buy a business, and let's say the seller wants $100,000 down, and you raise $200,000 in financing, now you're the owner of that business directly after close. You can take that money out and do whatever you want with it. Buy a house, buy a car, buy another business. It's your money. And then as the owner of that business, once you've done the debt service, so you've paid the payments to the bank or the investor or whoever, whatever cash flow is left in that business, and we show you how to forecast and calculate that so you're making money, all that free cash flow is your money because you're the owner of the business. But then as you grow that business and then you sell it, that is when you make the majority of the money. So if you look at the Manchester United deal, $8.15 billion is the total amount of cash flow that they're going to make. They took $50 million off the closing table. That was their deal fee, so to speak. They've took $1.4 billion out of that company since they bought it nearly 20 years ago, and then they're selling for 6.7. So those are the 3 ways that you get paid by doing deals. Bringing it down to kind of Main Street, I'd be thrilled and proud of you all if you can do $8 billion deals. Probably not going to happen, but $1 million deals you can all do. So if you do a $1 million deal, let's say it's got $400,000 of profit. I said before, businesses are worth a multiple of that profit. You'll learn how to do that tomorrow. So let's say that's a 2.5 times multiple, $400,000 in profit, $1 million deal. That deal might comprise of, say, $200,000 of existing debt that you're going to inherit, $400,000 as a closing payment. We'll show you where you can get all that money. And then $400,000 through seller financing, future payments to the seller. SBA deals. Going to do a really deep training on this tomorrow. The SBA rules have recently changed. SBA always used to want you to put 5 to 10% of the money down, but not anymore. You can use non-bank SBA lenders, and you can do 100% seller financing deals, and the federal government guarantees the majority of that capital. And what's great about an SBA deal is because you're putting a lot of the money down at the closing table, you can pay a lot less for the business, which is really, really cool. Annuity deals, we're going to cover that tomorrow. That's like buying a business like you would lease a car, just paying for it over an extended period of time. Very, very quick to do those deals. You can do those deals in a day, maximum 2 weeks. Seller can get more money because you're spreading it out. They'll pay less tax, lighter due diligence, a lot less stressful. Sellers are loving those deals. There's some people in the room that are in my protege program that I've been coaching. They're closing annuity deals all the time. We're going to hear from some of them this weekend. Bolt-on and tuck-in acquisitions is basically when you're combining businesses together. The difference between a bolt-on and a tuck-in. A bolt-on acquisition is where one business buys another and the two names of the businesses remain. A tuck-in is where you buy an assets of a company, stick it into the one you've already got, and you lose the original name and you just keep the one that you've got. Loads of benefits by doing bolt-ons and tuck-ins. As we said before, you're buying growth, you're buying opportunity, you're buying all the things that you want to do inside of the market. And just to kind of give you an example, let's say you owned an electrical company. Let's say it's called Ben's Electrical, and you wanted to go and buy a plumbing business called Jerry's Plumbing. It'd be a bolt-on if both companies' names remained. Then it would be a tuck-in if you forgot about Jerry's name and it just came together. But what's really interesting about doing these deals, so if you own an electrical company and you buy a plumbing company, you can sell your electrical services to all those plumbing customers that you just inherited, and vice versa. You've now got all these electrical customers in your existing business. They all want plumbing. Rather than send them down the street to somebody else, you've now got a plumbing service that you can leverage. So you get this cross-sell between the two businesses. And then when you combine businesses together, there's loads of cost synergies that you can take out. So your revenues go up, your profits go up, your valuation goes up, and as the owner of the business, your net worth goes up. So let's give you a financial example. Let's say Ben does $1 million in revenues, 20% profit margin, so doing $200,000 in cash flow. Let's say that's worth a 2x multiple, $400,000. And we go out and we buy Jerry's business. It's exactly the same size. And then if we cross-sell, let's say we get $400,000 of cross-selling revenue, which would only be 20%. We get 20% of cost synergies. We add all that up. We've now got a business doing $2.4 million. We've got Ben plus Jerry plus the cross-sell. Our costs are shrinking because of all the synergies that we can generate. So from doing one deal, we've grown the business from $1 million to $2.4. Our EBITDA has quadrupled from $200K to over $850,000. Now that business is worth a higher multiple because it's got more profit. So that business now is worth over $4 million. You've just 11x'd your net worth from doing one acquisition. And you'll learn this weekend how you can do these deals sometimes in a matter of days. So who wants to 11x their business value in 2 days? I'm going to teach you how to do that tomorrow. It's crazy. This is what the big guys do. This is why Amazon, Microsoft, Facebook, all these monster trillion-dollar companies, they've all grown their valuation by doing things like this, by doing acquisitions. A roll-up is where you buy multiple businesses within a particular industry, and you drive like crazy bolt-on synergies on all those different things. Tons and tons of benefits for doing roll-ups. Remember I talked before about why there's lots of buyers at 10, 20 million, but there's not a lot of buyers at 1 or 2 million. So if you do a roll-up, you can just hoover up all of those small, little, tiny businesses, create a larger group, which is a roll-up, and then flip that to a frenzy of buyers at that kind of higher level. So we'll talk about my roll-ups Saturday and Sunday. One of my business partners, Ross Turner, who actually started off as one of my proteges, now he and I are partners in a $1 billion deal, which is incredible. Mergers, so when two businesses come together, loads and loads of different ways that you can do that. So when we went through the Ben and Jerry example before, rather than if you were acquiring that business and generating all of that value, instead, what you're doing in a merger is you're just coming together. So Mark and Ali, they merged their businesses together. What they're doing really is just sharing that upside. So yeah, there's still an 11x increase in growth, but they're sharing that between them because neither one wants to relinquish control to the other. So you can do mergers as well. JVs, you can also do in deal making. If a deal can't be done, you can still have an opportunity to make money and add value. You can even buy little pieces of larger companies. So one of the coolest deals I ever did is I bought a tiny piece of a $6 billion company in the UK. They had a small business that they didn't want anymore. It had kind of been left to dwindle and fester. I just took that business for no money out of pocket, which is a really, really cool deal. You might think, well, you know what? I just don't want to own a business. I would love to make tons of money and do deals, but I want to own tons and tons of them. Chris is going to show you how to do that. And then this is really big boy stuff. So I don't want you to get overwhelmed by what I'm about to show you, but one of the really cool things that we do as deal makers is we can do these brokering of deals for others, these consulting for equity projects. You'll learn about wholesaling tomorrow. I'm going to teach you now about something called a paper merger. So a paper merger is, so let's say Nathan and Mark own businesses and they don't know each other. And Drew, through his networking, is meeting these guys. And Nathan says, hey, well, I don't want to sell. I want to grow. And Mark's like, well, I don't want to sell. I want to grow. So you're in the middle. Those two businesses are strategically aligned. You can jump into that deal and make a lot of money. This is how you do it. So let's say they both own $1 million revenue businesses, doing $200,000 of profit. Let's say Nathan takes 30% of the total NewCo, as does Mark. You, Drew, you're the deal maker. You get 20%. And then let's say you go out and you get an investor like me or Abraham or Chris. We buy 20%, and now you've got some capital that you can use to do a deal. So when you combine those businesses together, like I just showed you, there's loads of cross-selling and there's loads of financial synergies. So now you've got a business that's not doing $2 million when you stick them together. It's doing $2.5 million. Then it's making $750,000 of profit. And then we use the, let's say, $200,000 that we've put into investors, and we go and buy Brenda's company. We say, hey, Brenda, you've got a business you want to sell. We're going to do this deal. Brenda's got the same size of business. We combine that into the mix. We drive synergies again. We've now got a business doing $4 million, making $1.2 million. So that business now is worth $6 million, whereas individually their businesses were only worth $400,000. So now Drew, by doing that deal, he's just made $1,200,000 just by putting those three things together. Brenda cashed out. Nathan and Mark, they're still in that deal. They've took their valuation from $400K to $1.8 million. And you could do all that probably in 90 to 120 days. You're going to learn how to do that this weekend. Sourcing, wholesaling deals is really, really cool. I'll show you how you can make a lot more money sourcing and wholesaling businesses versus wholesaling real estate. Both are really, really cool. And I mentioned before, distressed deals. Only do distressed deals, businesses that are not cash flowing. Only do those if you have an existing business that can absorb those losses or those pain points. Don't do that as your very, very first deal. So there's lots of benefits of those deals, though. You can buy them for $1. Sellers. I call distressed business owners that have terrible businesses the guy with the bottle of whiskey and the revolver. They're the guy that they're about to blow their brains out. Can you take that business on and really do them a service? Can you save them from a lot of that pain, a lot of that misery? But only do that if you've got an existing business that can do it. Franchises, not a massive fan of buying franchises because I'm just not. I like businesses that can scale like crazy. I don't like constraints. Franchises have constraints, territories, locations, all those different things. I want to buy a business that can take over the world. There are advantages with franchises, though. Obviously, there's a lot lower business closure stats. About 75% of franchises actually do survive because they've got existing branding, proven processes, all those different things. I typically stay away, though, from buying franchises.